On behalf of the Community Foundation, welcome you to our professional advisory series, first one in 2025. We were just talking, how can it be January of 2025, right? Time marches on. We really want to just take this opportunity to thank you for coming and spending time with us. And probably most importantly, being conscientious of lifting up charitable opportunities with all of your clients. And of course, we love partnering with you in helping to carry out those charitable goals with all of your clients. It's really a privilege for us. In 2024, over $3 million of our new assets came to us through estate and plan gifts. And so we know your voices matter, and lifting up those opportunities, whether it's with us or any other charitable direct gift, of course, we're big advocates for it. So we really thank you for that. I wanted to also mention and thank our investment committee and board members that are with us either here today or virtually. Of course, today our investment committee works in partnership with Marquette Associates to carry out the fiduciary responsibilities and managing our assets. And our assets now are right around $173 million. So we had another great year, and it's a big responsibility. And we appreciate you sharing that expertise that you bring to the table and giving back to your community in that special way. So I would like to recognize our investment committee members. So I know Rashonda Young will be joining us a little bit late today. She is our past chair and also chairs our investment committee. Mike Hume is also on our board of directors and has been on investment committee for several years. Nick Blasberg, he's a new board member. He's on a federal trial right now today, so he's not here with us. And Matt Monahan, those two will be joining our board of directors, and we're really excited to have.
Hey, is Nick on trial?
He's in jury duty.
Oh, jury.
Right. What I say?
Yeah.
It's a federal
He's
trial.
on federal trial, not him.
Oh, no. Yeah, good catch. Yeah. Former board member Pat Monet is with us today. Betsy Vogel is joining us virtually, I believe. Jason Hassman is virtual, and Garrett is here in person with us. Jarrett Atkins, Justin Dams, and Christy Brown are all part of the investment committee group. And our committee meets quarterly, and again, and always in collaboration with Marquette Associates to make those important decisions and to monitor assets. So also then one of the major responsibilities of the board of directors, of course, is providing that oversight, our fiduciary responsibilities. And as I mentioned, our assets have grown to over 173 million now. And what makes that really exciting and important to us is the generation of the grants that come from those assets. So in 2024, we granted over $9 million across our region in charitable causes of all kinds. And so during our 68 years of service to our region, we granted out over $143 million. So pretty exciting to be a part of an organization that's making the charitable impacts across our region and doing so much good work in leadership and engagement in our community. So I'd also like to just recognize a couple of our staff that are with us today. Actually, the whole leadership team is here today. Angie Widner, Liz Kurt, and Jake Byers. And then I wanted to recognize Nicole Stewart, who's not with us here today, but again, works really closely with Jack and Marquette's team to manage all of the work behind trades and charitable gifts and all the details. And then the charitable impact team. So you probably noticed that I'm like here by myself today in charge, which is showing Mike that this is what CEOs do, right? He was giving me a hard time. So Terry Gomer and Derek Kimball both serve with on our charitable team, and they're both out in our region meeting with other organizations this morning, so they couldn't be with us. So just wanted to mention that to you. And then the other thing that we wanted to draw to your attention is many of you have engaged your clients and or personally in taking, taking advantage of the Endow Iowa tax credit, which is that 25% state tax credit. And due to the sunset of the Tax Cut and the Jobs Act, we do anticipate that the Endow Iowa tax credit may be used up more quickly this year. So if you do have clients that are planning on maximizing their charitable tax-wise giving, you might want to encourage them to give earlier in the year. And I think the only other thing I was going to mention before I introduce Dave is that this is one of our 4 events, PA series that we'll do this year again. Our next one is April 8th. We are going to do something different this year in the summertime. More of a social type of event here, hoping for a really nice day out on the patio, have some beers and adult beverages and have conversations and do a little networking. And so we're in the process of working on what that might look like this year as well. So just a reminder too, that if you need those CLEs and CFPs, kind of, the routine probably. Those of you in the room, make sure that you've signed up out there. And then those that are joining us online, Derek will get back to you and make sure we have all your certificate numbers and things so we can get those filed as well. All right, I think I did all my homework. So next I will go ahead and introduce Dave Smith. I don't think he needs much introduction, at least with those of us in the room today. We've been working with Dave and his team now for almost 12 years. They're right around 12 years. Dave is a managing director at Marquette Associates and serves on the firm's executive committee. He's an owner of the firm. Dave's been with the company since 2009, and he has 26 years of investment experience. He leads the healthcare practice area at Marquette and is a member of the Endowments and Foundation Services Committee. Dave serves as a lead investment consultant on several client relationships. Our foundation is his favorite. That's right here in the right there. I saw it. Dave has his BS in business administration from the University of Richmond and an MBA in finance from the University of Chicago Booth School of Business. And joining him today is who'd you bring today? Jack.
He took me up to the airport. I think it's later.
Yeah. Jack's honest, who grew up here in the Cedar Valley and has been really great to work alongside both of you. So I'll turn it over to you. Thank you very much.
And when we were hired, which was in October of 2012, Jack was in
Junior in high school.
Jack, as of January 1st, is a newly minted VP at Marquette.
Yes.
Something in the soil.
That's right. Yeah.
And I think this is probably maybe the 10th year that we've kicked the year off with the market preview, and it's really a chance for us to reflect on what's happened over the years and to think forward. And this is a chance for the folks coming in, not on the board or the committee, to think about what you can prepare for with your clients. And every year, it's the start of every year seems overwhelming. And this year in particular, with a dramatic shift in administration and perhaps sort of political focus, geopolitical tensions definitely seem to be a little bit more tense than they have been in the past. And we have been in the midst of some sort of geopolitical turmoil for the better part of the last 4 decades. So that's nothing new, but it seems to be just a little bit more tense. And for me, looking back last year, never really expected to see the year that we had in 2024. I think most of us were surprised by the performance of U.S. equities in particular, but then we recognized it was really distilled down to a handful of different names, and the rest of the S&P 500, non-U.S. equity markets, fixed income, alternative asset classes really didn't perform all that well. But we saw this huge tailwind from a relatively new innovation, artificial intelligence. And that gives us great optimism. But if these strategies and technologies aren't adopted, we may not be able to see this level of tailwind. It also reminds us, too, of just how innovative and entrepreneurial our system is in the United States. Capital flows from providers of capital to good ideas. And we do not see that happening in the developed market Europe. Perhaps we see that in some areas of Asia, but emerging markets have disappointed. And it really has been large cap stocks that have dominated performance. And we see that on the first slide. Everything in purple, U.S. equities, non-U.S. equities, and fixed income. And the biggest driver of growth was U.S. biggest driver of performance was large cap growth, technology, and then specifically that Magnificent Seven. Everything else was certainly on the positive side, but did not keep pace with what we saw from U.S. large cap. And we did see some signs of healthy performance from core fixed income, especially as interest rates came back down, but the 10-year crept back up towards the end of the year. And performance, even though yield has been more attractive, really didn't amount to much in terms of return from fixed income. But what really is staggering is the last 2 years was only the 5th time ever, or at least since almost 100 years, where we've seen back-to-back performance or return from U.S. equity of 20% or more. The last time this happened was during the .com, and we saw 3 consecutive years of negative calendar year return, which has never happened. So we're truly in an unusual market environment, and with the exception of 2022, when we saw rising interest rates and put downward pressure on equities and fixed income, we had almost 3 years of consecutive return of 20+% or more. And much of that has been driven by a significant amount of economic stimulus following the GFC, and then more recently following COVID. But it never would have expected this time a year ago. The outlook from banks, from investment managers, from firms like ours did not suggest that we were going to have another year of 20% from U.S. equities. And really what's been driving that are themes around inflation and the path of interest rates. And we see just how reactive markets are to news around job growth, to inflation. And we started the year that way. We saw an attractive jobs growth number that suggested the Federal Reserve probably won't make more than one cut in 2025, and equity sold off. And then this morning, we've seen positive news from banks. Earnings seem to be more attractive, and perhaps some inflation is cooling a little bit more than expected. And we've seen another rally. So the volatility around inflation and interest rates is really the key driver. And so the main illustration here, the inflation levels in 2022, and it's hard to believe that that's 2.5 years in the rear view, peaked at around 9%, the highest level of inflation in 40 years, followed by a very aggressive path of interest rate rising to bring inflation under control. And that has certainly dictated the path of equities. Behind that is employment numbers, wage growth, and just the health of the U.S. consumer. And we've seen unemployment levels that were very, very low prior to COVID, the lowest level since the 60s, a huge spike in unemployment as a result of a global pandemic, came back down to pre-COVID levels south of 4%, and they've been steadily creeping up, still in line with what we would expect over a long-term average, unemployment right around 4.1%. And to the extent that we see a higher increase in unemployment, we could potentially see more interest rate reductions. Part of the reason that we've seen inflation maybe a little bit stickier is that wage growth is still above historical averages, with a slight increase just lately. Higher wages, higher spending increases the velocity of capital. All of that increases overall inflationary pressures. And the consumer has been very, very healthy. Real consumer spending. There's a lot going on in this chart, but the green bars in particular suggest that the consumer really has been a key driver of overall spending, overall economic growth as a result of relief from COVID, more disposable income, wage growth. And then we see an immigration shift that creates more growth opportunities in the U.S. And there's plenty of debate around the right way and the wrong way to embrace immigration, but more people are coming to this country for a reason. They're working, they're spending, and that leads to growth. By contrast, we think about markets that historically have been closed, like Japan, and there's just been stagnant growth. So there's clearly is a benefit, but there's political tensions that apply to the way that immigration has been applied. And so what does this mean for interest rates? And so everything illustrated on this sort of the left-hand side that's not highlighted in gray, those are the interest rates at the FOMC meeting. And it's hard to believe that started almost 3 years ago. The FOMC meeting in March of 22 was the first interest rate hike. And then that continued for, I think, 10 consecutive meetings, a brief pause, one final hike in July of 2023, and then a pause for about a year before the Federal Reserve applied the first interest rate reduction in a number of years in September, 50 basis points, another cut in November, another cut in December, bringing total reductions from 5.5% to 4.5%, which has certainly been accretive to equity markets. But based on Fed fund futures, this is not based on any sort of economic projection, but rather what markets think. There does seem to be a pause in interest rate reductions. In all likelihood, we may not see another one in 2025, unless, of course, we see a stalling in employment, we see an uptick in inflation. But the likelihood of encountering another or a recession compared to where we were just a year ago is much lower. Markets, either the Bloomberg consensus or the Goldman Sachs poll, does not suggest that we are reaching any sort of recessionary pressures. And one of the things that Jack read, that floor is about 10%. Most pollsters don't acknowledge, or there's some sort of recessionary belief at around 10%. So we are at very low levels of inflationary pressure, recessionary pressures as a result of the Federal Reserve ideally navigating a soft landing. And if anybody has questions, just throw them out there while we're going. I'm sure there's plenty of things on your mind. But we're obviously turning the tide of political influence. That was a very contentious, exhausting election process. And the Trump administration, and this is part of the way that he seems to approach negotiation, makes some bombastic claims and it executes at a different level. So it's very difficult to distinguish between what he is suggesting and what will actually happen. We did see some signs of this in his first administration, but the key sort of plans, I really just focus on tariffs, immigration, and deregulation, and the expectation to economic growth, to inflation, and to overall impact. Tariffs are an inflationary pressure. It just increases the cost. Now, whether or not he follows through to the extent that he's suggested, and China and other major trade partners surely have a plan for each one of these, each one of his suggestions. But based on what what Trump has suggested, tariffs will cause inflationary pressures. Shifting immigration, pulling people out of the workforce, that will create job openings, that will create higher wages to entice people to come back into the market. That also has an inflationary pressure. But deregulation, and it's important to distinguish or what we actually mean here. And I was at the JP Morgan Healthcare Conference on Monday and Tuesday in San Francisco, and Jamie Dimon, very well-respected CEO of JP Morgan, who was very candid, very forthright, wanted to make sure that we understand the difference between sort of deregulation and removing responsibility. Regulation has created just a stifle to business growth. We don't want to remove responsibility from the oversight of companies, but deregulation tends to lead to more growth opportunities. And the expectation is that with less oversight, with more free capital, that we should see more growth in business across a number of different industries. But anyway, these slides are available to you if you need to share with your client. There's perspective on a couple of other policy changes, but we don't yet know what these policy changes will be. And all of this will be brought to life over the course of the next few months. But the tariffs, at least based on what we know so far, would be at the highest level in the last 100 years. And I don't think the intent here is to create a new source of revenue, but rather to entice manufacturing firms to bring those enterprises back into the United States, to create more jobs, to perhaps protect more security, to protect technologies. But obviously, this would be a dramatic increase in the tariffs that have been applied over the course of the last 100 years. And then based on sort of specific industries, and there's a lot of blurriness with this, but deregulation policy shifts would probably be very accretive to financials, less oversight of deals, more free flow of M&A, of transaction activity. And private equity, and we'll get to this towards the end, has been stifled. We have seen very few exits. We have seen less deployment, and all of that has led to lower returns from private equity. But now that we're reaching some sort of, call it plateau or some sort of base with interest rates, we would expect M&A activity complemented by a significant amount of dry powder to influence overall transaction activity. Traditional energy, more fossil fuel drilling, more expansion, more construction of pipelines, transmission, all of that would be accretive. By contrast, healthcare, renewables, in some areas of technology, antitrust, decoupling of companies, renewable energies being suppressed by the federal government, all of that could be contractionary. So a pivot to fixed income, and the way that we've structured this similar to years past, a macroeconomic perspective, and obviously in the impact to fixed income, equities, and alternative asset classes.
So we'll switch gears here to fixed income and just continuing on with Dave's story here. I think what's on tops of mind of most investors is kind of the mounting government deficit. And then as rates have risen, the cost of interest to service that debt. So you can see kind of a projection here, kind of at the start of each of the next several decades here. You can see the total level of U.S. debt at about a little over 100% of GDP as of today. But at the current pace we're going, that'll continue to ramp up, above 200% by 2053. So $36.2 trillion of current U.S. debt. So definitely a gloomier picture and something we obviously don't hope for. That's definitely put the Treasury curve under pressure. So in a year where the broad U.S. aggregate bond index returned a little over 1%, looks pretty benign, but under the surface, definitely not benign. And there was a lot of volatility we saw through the year. So these two lines here, the yield curve as of the blue line is the end of 2024. And then the gray line as of 2 months prior at the end of October, you can see the whole curve essentially shifting upward while the Fed was cutting interest rates. So definitely counterintuitive to what we would have expected. Really just as that debt just kind of continues to mount, investors are demanding kind of a higher return on holding those government bonds. It's really pushed out the longer end of the yield curve, or that term premium, the compensation for holding longer dated bonds is now there, as that yield curve starts to uninvert, where the shorter term bonds have been paying a higher yield than longer term, which is what in the past has typically led to a recession, but doesn't seem to be the case this time around. So not a perfect indicator there. Just more graphically, that term premium. So it's changes throughout, or has changed a lot since 2000. So again, this is just that compensation for holding longer dated bonds, typically looking at the 10-year Treasury yield. You can see that term premium now dipping more recently back up above zero. So now there's more compensation for holding those longer dated bonds. So start to return to normal, and part of a higher yield environment, you just earn more income for holding U.S. Treasuries than you did previously.
In the term that surfaced, and everybody in this room is probably right about, is a bond vigilantes, right? Wanting to be compensated for the increasing amount of risk of a more indebted nation. And we are starting to see a normalized yield curve, but that is emblematic of more risk. And while the Federal Reserve controlled by policy the short end of the curve, the longer end of the curve is determined by capital markets. Bond holders selling bonds, driving down prices, driving up yield, somewhat counterintuitive that we would see policy rates decreasing. We would normally perhaps expect to see a parallel shift in the yield curve and the long end coming down, but that hasn't happened. But to Jack's point, we are returning to a normalized yield curve where there is some level of term premium. There is more risk for holding bonds for a longer period of time, and investors want to make sure that they are compensated for that. But of course, for core bond, which has a duration of around 6 years, that's putting downward pressure on fixed income, and part of the reason we saw sort of another year of disappointing fixed income return.
Any questions on fixed income before we switch over to the equity markets across the world?
I mean, the positive news is that yields are higher. We are being compensated for a relatively safe area of the market in terms of higher yields, but to the extent bond prices increase or yields increase, those prices come down.
Some experts think that doesn't matter what the deficit is.
the federal deficit. Have you heard that there's that Stephanie Kelton? How do you guys feel about that? I feel like it would matter, but you
Yeah,
know,
I mean,
just keep printing money or whatever.
the US is and maybe not always will be, but that is an area of safety. And it's a reserve currency. Capital will continue to flow, and there will be buyers of our debt until it gets to the point where it's no longer viewed as safe. But China, as an example, one of the largest holders of our U.S. debt, if they chose to sell our bonds, that would inflate the value of their currency, making their products more expensive throughout the world. I mean, anything's possible, John, for sure.
Yeah.
But in all likelihood, this will continue to be one of the safest areas of the market where you are rewarded. And to the extent that yields come up, we would expect to see more capital flowing in, buying those bonds, capturing those higher yields at the longer end of the curve, which would create stronger currency or a stronger dollar. And that's been a key driver of U.S. equity outperformance. I mean, anything is possible, but it doesn't seem like there will be an exhausted appetite for American or U.S. issued debt.
So looking back at 2024, a very strong market year. As you look under the surface a little bit more, it was kind of the Magnificent Seven, those mega cap tech stocks really leading the way. You can see across this chart here, that blue line, that Magnificent Seven really driving the returns. And then you've got three other lines following a similar path, which is just the S&P 500 broadly, which was positive and did well. But then you take out with the gray line, the Magnificent Seven from the S&P 500, and then the Russell 2000, which is a small cap benchmark, returns look a lot more muted. So really it was a year of, you can see in the middle there, that NVIDIA and AI driven rally through kind of the middle of the year, some more negative jobs reports and a few Fed rate cuts there. And then finally ending with the presidential election. And in most presidential election years, kind of regardless of what party wins, equity markets are positive and usually pretty decisively. And that was no different in 2024. So really it was the focus. You kind of felt like broken records every meeting to the investment committee talking about the Magnificent Seven, but truly it was a profound impact on US equity markets. And that kind of continued to be the case kind of through all parts of last year. Market concentration, I think this is interesting and a concern with just kind of the broader US market in particular, is how concentrated those stocks are becoming. And so again, it says it pretty straightforward here at the top. Those top 10 S&P 500 positions fueled 60% of the 2024 return for the broad benchmark. So just those top 10 names really had an outsized impact. And less than 30% of those stocks bested the index that year. So you can see here that if the return bars, those brown bars there, are above the zero axis, that's a positive, that the S&P 500 is outperforming. And then below that is the equal weighted, so kind of accounting for more of the smaller cap names outperforming. And you can kind of see this goes back to 1990, but especially over the last 2 years, as we've seen the S&P 500 outperform, the orange line there, just that weighting of those top 10 stocks has kind of gone more parabolic and has gone a lot higher. So really those returns being driven by those top 10 names. And decomposition, so a lot of bars, a lot of numbers here. Just what is the component of those returns? I think if you look at 2020, 2021, that green bar there is the earnings growth. So unsurprisingly, as companies didn't do well during COVID, everything starts to reopen back up. You see that tremendous earnings growth there. And in a normal market environment, you want to see kind of, earnings growth, dividends, and valuations kind of carry the market up. You had seen kind of before 2020, just valuations really carrying the market, but 2024 was more balanced. There was actual earnings growth from these companies. They were doing well. The consumer, the strength of the consumer really helped that, but also saw valuations creep higher and higher as investors did pile into those larger cap tech names as the year went on.
What's your commentary on, with the higher interest rates, is that going to be a drag on earnings growth?
Yeah, and I mean, we see that first and foremost with small caps. Interest rates came down in November. Small caps had their best month of the year. The exact opposite was true in December when the 10-year started to float back up. Small caps got absolutely crushed. Larger cap companies have different sources of financing, different accesses to capital markets, and are not so heavily influenced just by sort of a line of credit or short-term interest rate or interest rates. By contrast, small cap companies have fewer providers of capital and they get absolutely smoked. And what's sort of interesting, I mean, for years and years, allocators, had expressed a small, bias for a small cap premium. That was a source of outsized return compared to large caps. And that has certainly been eroded over the past decade for a couple of different reasons. Private companies are staying private longer. That small cap premium really has transitioned back to private markets. And the small caps as a percentage of the Russell 3000 or the broader U.S. equity market historically had been around 10%. That has floated now south of probably 4.5%. So having an overweight or even a modest overweight to small caps relative to the Russell 3000 or relative to a Russell 1000 was dilutive to return. And it's difficult to envision an environment where that small cap premium comes back unless we see an about face in the way that investors are accessing private markets.
But good transition into earnings growth, kind of where we think the areas of the market will grow, and kind of across the board, the consensus is for earnings growth in the next couple of years, especially within the U.S. market. Some more outsized earnings growth. There are just some structural differences here in the U.S. compared to the rest of the world that really have been, carrying equity markets higher. And we've just kind of seen this dispersion between the U.S. and the rest of the world, but kind of across the board. You see the lighter bars are kind of more into the future. The darker green is kind of where we're sitting now. So although a little more of an outsized, estimated growth kind of within the U.S. in the shorter term, it appears longer term that there's a potential for things to broaden out kind of to the rest of the market and not see that concentration of gains that we've been seeing over the course of, the last 2024. I think this is just a really profound, interesting chart of just kind of what we're dealing with how large these large companies really are. So purple bars here, the top 5 largest stocks in the US market. The green bars here, the 5 largest countries in kind of this global equity index that are not the US. So just the weighting of those compared to each other. So Apple is about as large as Japan's weighting in the index. So the one single stock is as large as an entire country. And then you can see kind of across the board, NVIDIA is larger than the UK. Microsoft's larger than Canada. So we're dealing with these countries these companies that are larger market cap than whole countries are. And so it's really the structural difference. If those are doing well, that is just such a significant weighting because it's as large as an entire country's equity market. So that's what we're up against here, just with kind of how large these countries or companies have grown. I keep getting countries and companies because that's just how large they are. So if they're performing well with strong balance sheets, it's hard to see things changing from there. So, and switching gears a bit, especially for U.S. investors, if you're investing elsewhere, kind of outside of the U.S., the effect of the U.S. dollar really can have an outsized effect on your returns, even if those non-U.S. companies are performing well. And so as we've seen our rates here domestically stay higher for longer, that keeps the dollar stronger relative to currencies around the world. Really been a thing that we've seen since kind of 2022, the hiking cycle, kind of see everything kind of moving down and to the right, with the purple bars being developed market currencies and the orange bars being emerging market currencies. You can see EM fared a little bit better in the fourth quarter, down 3.6%, but developed market currencies down 7.5%. It's been tough as U.S. investors to kind of see non-U.S. equities outperform U.S. equities. And I'm sure kind of in your client meetings, you're seeing this, where there's just kind of this persistent outperformance of U.S. versus non-U.S. and kind of positioning going into 2025 is that's poised to stay the same. The U.S. is continuing to grow. You're seeing geopolitical risks outside of the U.S. There seems to be a new issue every day in a different country. One day China's great. One day China's really struggling. It's hard to keep up So again, just currencies are kind of another layer to that equation for US investors when looking to invest outside of the US.
And within the foundation portfolio, we have brought down the allocation of non-US equity and brought up the allocation to US equity to continue to try to capture that trend. And of course, the rest of the portfolio, private equity, real estate infrastructure, all of that is US based.
And just kind of demonstrating, since 2008, just kind of how long this outperformance has persisted. You kind of see the orange bar here, just the earnings per share of the S&P 500, kind of since that 08 reference point, just continuing to go up and to the right, and just kind of both developed in the dark blue and emerging markets in the light blue kind of maintain in the same position. It's just been continue to be a structural difference with the US outperforming.
Is communism part of the reason why China on a couple slides back was so like compared to Amazon? In other words, they don't have, I don't know enough about this to ask an intelligent question even. I don't think they don't have enough private ownership of or buying stocks of Chinese companies. They're not on the market. Is communism part of the reason? Because that just blows me away.
Yeah, and so I think what's included here is these are not China A shares. So these are Chinese equity shares that are available for the rest of the world to invest. And so a couple of interesting points, right? So I mean, the Chinese economy was largely influenced by a tremendous amount of debt in real estate fueled by their federal government. And then there was a stimulus measure that created some outsized performance for Chinese equity in August or sort of late 2024. And much of that has been eroded as H shares or non-H share investors have been able to withdraw. But Chinese equity, local Chinese equity that's only able to be bought and sold by folks in the Chinese mainland have maintained that level of outperformance because they haven't been able to sell capital. But I mean, so much of that is heavily influenced by debt and by spending from a communist country. The other sort of interesting observation, if you go back to the another way, keep going. Oh, sorry, it's down. It's the line graph with U.S. equity. There you go, right here. So, I mean, this really does underscore, especially for EFA, which a large constituent is just developed Europe in the UK. There isn't that element of innovation. Innovation isn't rewarded. Demographics have absolutely stalled. And granted, there is probably more immigration and maybe something like Germany, France, et cetera, recently. But that innovation just isn't rewarded and capital doesn't flow as freely. Huge restrictions on energy, huge restrictions on innovation. The allocation across sectors and EFA markets tend to favor cyclicals like industrials, manufacturing. By contrast, energy or technology and communication services represent almost 45% by sector in the S&P 500. Now, that's representative of the innovation and the way the capital's flowed. It also creates a huge concentration risk, as evidenced by the Mag 7 and just technology in general. If we do see a huge decoupling, if we do see more antitrust regulation, which is probably less likely under this administration, that could impact and perhaps create a sell-off in a very concentrated area of the market, which is why we still have some exposure to non-U.S. equities. To even out and dilute some of the concentration risks that we have in technology by just being invested in U.S. equity.
Thank you.
And then I'll just wrap up before I turn it back to Dave here. Just with kind of the room to run for so long, where does that shake out longer term? And really, there's not the October 22 bar, but pretty much from 09, save for the 1 month downturn. That was from 09 to 2022. That was an entire bull market run, save for that pullback. So there certainly can be some legs to this. This one is just kind of going from a relative basis. You can see on the bottom, the kind of the average length, it's not yet approaching kind of that average length, and annualized returns are kind of matching up with a bull market, certainly with pullbacks, that will happen in equity markets, but there certainly could be room to run in U.S. equity markets, especially with a lot of these structural differences that we've been mentioning. So,
and then, since 2020, since 2012, when we really institutionalized this foundation portfolio, which at the time was only about 150 million. Now the value of the portfolio is closer to, or is over 150 million. We've added asset classes like real estate, like private credit, infrastructure, real assets, and private equity. And those markets tend to ebb and flow differently than we see from public markets. And that's a pattern that tends to repeat itself. But one of the most beleaguered areas of the market has been real estate. And what we're experiencing now, very similar to what we experienced following the global financial crisis. We saw equity markets tank. We saw real estate continue to perform well for another 12 months. Equities recovered in April or March 2009, and we saw a cratering in real estate. And part of that reduces the overall volatility in the foundation and other institutional portfolios. But it's been a little bit different this time. We've seen a dramatic shift away from office space in core cities will be challenged for some time. The vacancy rates in Chicago are 25%. Buildings that are 30 years or older really are outdated, and it's going to be very difficult to replace or rehabilitate those properties. And the same is true throughout sort of, gateway cities in the US. I was just in San Francisco, and this JP Morgan Healthcare Conference is massive, and it was postponed or held virtually during the 2 years of COVID. And the first year back in 22, tents and homeless were all over the place. And then last year, Xi Jinping came in, and the then mayor, London Breed, just cleaned house, and it was very, very clean. And the same thing was true, at the conference just recently. But the vacancy rates in the financial district are higher than they've ever been. Work from home, especially for tech-enabled businesses, makes it very challenging. And we see that here, we see that in major markets, and it just, the reality of office workers coming back 5 days a week and the business spending that they bring with them seems to be challenged. But other areas of the market, we're starting to see some price improvement across multifamily, industrial, retail, self-storage. And an interesting observation, the NCREIF Odyssey, which is the bellwether benchmark for what we define as core real estate, which historically has only held these properties, is expanding to hold additional properties, data centers, life sciences, medical office, self-storage, hotel, senior and assisted living. So there's more and more ways to deploy capital in the real estate space that don't make us beholden to office. And just probably 3 years ago, office represented close to 37% of the NCREIF Odyssey. That number is now down close to 20% as the values have come way down and as managers have tried to shed those properties. But the good news is after 8 consecutive quarters of negative performance, we are starting to see perhaps signs of life, scraping a bottom, not across maybe all sectors, office especially, but transaction volumes are improving. And what we are seeing here is just the delayed reaction from an asset class that's not valued on a daily basis like we see from equities. When there is a rebound, investors are able to put capital to work immediately. There's a very narrow bid-ask spread, and we see a rebound. Transactions and valuation in the real estate space, private equity space occur periodically. And there seems to be, especially with the stability in interest rates, buyers and sellers are coming back together. Transactions are occurring, but maybe at discounted prices. But that allows for capital to be returned and markets to be brought back to normal. And it's very similar to what we experienced in 2000 or following the global financial crisis. And just to illustrate that point, these are inflection points from, when we think about real estate, the components of return, especially the way that we invest in real estate, income and appreciation. And most of the return from the real estate properties in the foundation portfolio really sourced from income. Fully occupied buildings with tenants paying their leases on time, that leads to an income component that's on average is probably around 6%. And the appreciation of these properties is generally consistent with the overall level of inflation. And one of the things that we can observe in every single instance, dating all the way back to the 70s, that income component is consistent. There has never been a year where we saw income decrease. And following the global financial crisis, when interest rates came down to zero, This was a very healthy complement to a low yield environment. And that's when we brought up the real estate allocation of the foundation to around 15%. We've since brought that back down and reallocated. But there are very clear inflection points based on supply demand, a number of different outliers, global financial crisis, COVID, where we saw appreciation compress. And that creates good entry points, right? It's a good time to buy. It's a good time to rebalance. But the steady allocation of income really is interesting that does not dissipate. And then we'll end on private equity. We added private equity to the foundation portfolio, and this is an asset class that's been more widely embraced by institutional investors over the last decade. The number of publicly traded companies has declined. The number of private companies backed by institutional capital is increased exponentially. There are more and more opportunities, and this is an environment of entrepreneurialism and capital flowing to areas of the market that need it. Excellent opportunities in the private equity space. But over the last year, especially, and this is as of 9/30, there's a delay in private equity valuation. When large cap and all cap stocks are up 35% and the marks in private equity are relatively stagnant, we see a huge reversal in that trend. And that impacts performance over the short term. But over a 10-year period, we do still see that outperformance of private markets. Investors should and are compensated for that illiquidity premium, buying small companies, holding them, exiting those companies. But that's certainly been challenged over recent time periods. And part of the reason is we saw this huge increase in exit activity in 2021. Exit activity, these are private companies that are sold either to public markets, to other strategic corporate buyers, to other larger private equity sponsors in a very low interest rate environment. And interest rates started to increase, buyers and sellers gapped out. It was very difficult to determine what the price is or the value is for a private company. Owners of private companies didn't want to sell at a discount. Buyers of private companies wanted to buy at a discount, and they just gapped out, similar to the way that we see gaps in pricing or spreads in public markets over a much longer time period. But we are starting to see an increase in exit count. That means more money coming back to investors like the foundation or to other institutional investors, and that creates more deployment of capital. And we see an ebb and flow in private markets over time, but we are starting to see a return, and that should manifest in better performance from the private equity portfolio. And so where the foundation in particular invests is in this lower middle market area, call it $100 million valuations or lower. It's those two light blue lines. Part of the stress that's placed on private equity that we read about in the Wall Street Journal, these massive firms, Carlyle, Blackstone, KKR, that are buying companies, 500 or raising billion-dollar funds, writing huge checks, and there's very little room to extract value. That is absolutely not where this foundation is investing. We are buying very small companies and we are selling those upstream. It creates more opportunity for exit, better inventory, and those are still trading at a relatively attractive multiple, 8 times EBITDA versus some of these larger companies. So it's an attractive area for smaller or middle market investors to be, is in that lower area of private equity, where we do think we can continue to extract return. And then we'll just end on just sort of some forecasting. What do we expect from Fed funds, from GDP, from unemployment? And we do expect a downward trend in overall short-term policy rates coming really back to normal from 4.5% probably over the next 3 years and somewhere around 3%, which is still high from, or I would say, even with what we would expect over the long term. No real meaningful changes in unemployment. 4% is typically viewed as a healthy level of unemployment, and inflation perhaps trends down a little bit. So there isn't any sort of massive change in expectations except for perhaps Fed funds. And if those rates do come down, that is generally accretive to equities and to fixed income. But we will pause here and happy to take any questions. And again, these slides are available if you'd like to share them with your clients. We produce plenty of content. This deck is 100 plus slides. We distilled it down to 36. We can look at all of them if you want. What's on your mind? I mean, I feel a little bit more anxious than I have in previous years.
Can you give some commentary on mortgages, housing market, seems like there's a lack of supply, fairly, nationwide. Home builders, although, I know one had a good report yesterday, but can you just kind of give some commentary on that market and how that might affect inflation?
Yeah, I mean, so obviously higher interest rates have stifled buying and selling to begin with. Inventory of new homes has certainly created a lot of that supply demand imbalance. And I don't think developers are rewarded in ways that they have been in the past. They are taking on a significantly more risk, and they're not bringing to market more inventory. The other difference, so one of the more interesting metrics, I'm sure all of you have seen this, the price of a home relative to the wage that American family earns has increased dramatically. And that makes it much more expensive. And one of the things that has changed versus maybe a generation ago is you have owners, institutional owners of single family homes that are building homes and are renting them back, and it just increases the overall cost. We think about markets like Chicago, closer to the city, you have to tear down you really have to tear down a house to rebuild a new one. And that becomes very, very expensive. Obviously, there's plenty of land to expand out, but then you get further and further away from the central business district, which maybe isn't as important as it used to be. But that's obviously been a significant driver of inflation. The higher costs of mortgages recently, the limited amount of supply, and institutional buyers or institutional owners of homes that then rent those back to people that can't afford to buy it themselves. Anything to add on that, Jack?
And then I think even what you're seeing in California right now with those wildfires, kind of add more pricing pressure to the upside. So, I mean, great spot to be if you're the owner of, a multifamily apartment building, like what's in the foundation portfolio, because you're going to have more people looking to rent and occupying those buildings, but certainly isn't addressing kind of the lack of housing broadly that kind of benefit most being for home.
And if I'm under a mortgage at 2-3%, I'm not too eager to move either.
Yeah. And when the cost of materials spiked incredibly during COVID, and I think, there's a huge lag in sort of development. We're starting to see buildings in Chicago that are completed that were started well below COVID. Sort of think to yourself, who is going to move into something like that? Mm-hmm. But those costs of plywood and copper and 2x4s, all of those have come down, hopefully create an environment to build more homes.
Dave, a lot of advisory firms, I imagine, have U.S. large cap blend as their largest asset allocation, and a lot of times that's a S&P 500 index. Given the last 2 years, given the concentration risk, would you, if you were advising on the portfolio, would you say this would be a time to dial back that allocation?
Yeah, so within the foundation portfolio, we are incredibly well diversified across investment grade fixed income, below investment grade fixed income, private credit, private equity, real assets. And then our allocation to equities have really come down over the years. Now, being just in large cap equity, that would have been one of the best places to be. But for those investors that don't have access to other asset classes, yeah, I think that does create an element of concentration risk. 2 consecutive years of 20+% is probably not sustainable. And at some point, and those valuations are stretched, those values or those numbers or those prices will come back down. So I don't think it's a huge risk for the foundation, but for those individuals who can't diversify across private markets or real assets, that probably is a risk. Yes, sir.
This is probably going against your philosophy, but I get a kick out of all the stuff that I get inundated with on the internet every day that says and it'll be, well, this guy picked this to happen and so on. And there's this guy that's saying the Dow's going to 50,000. So in an effort to be the first group to hear from you guys, when do you think it'll hit 50,000?
What, the Dow? Yeah, well, if we see a decline in interest rates, that's certainly a possibility. And we've been doing this long enough to know that we can't react to that sort of prognostication. And there is no substitute for a thoughtful, diversified portfolio that aligns liquidity with risk return characteristics. And this time a year ago, all the banks were projecting, a hard landing, and that never happened. What nobody had anticipated was this rally, and nobody knows, we could very easily see a pullback. Bear markets, a sell-off of 20% or more occur about every decade. We saw one during COVID. Corrections occur, sell-off of 10% or more every other year. We're certainly poised for that as well. But really, what's underscoring all of this return has been driven by just a handful of names. And if those technologies aren't embraced, if companies that have been investing can't monetize that level of innovation, we are going to see a sell-off. And what we can anticipate is the impact of some sort of antitrust regulation, which again is probably less likely. But having such a high concentration in just those 7 names, makes us a little bit anxious. Now, of course, that's diversified and allocated across benchmark weights, but that is a concern. Should we start over?
Yeah. Dave, I'd like to hear it.
Any other questions for Dave or Jack? Minute left. No? Well, thank you very much again for coming and sharing all of this stuff. Great data. And as Dave said, there's more pages. If you'd like the full report, you're welcome to that as well. But we will be sending out this slide deck along with the follow-up from this meeting. And again, just a reminder that if you need CEUs, make sure that you either signed in when you came in today and or that Derek will follow up with you afterwards to get your numbers there. So we will go ahead and dismiss. Again, we say thank you. And those of you that are on the investment committee, if you'll stick around, we'll move right into our investment committee meeting then. So thanks again.